Can I break down my entry fees for buying an investment? Does it cover acquisition? Okay, this is perfect. This is also in the calculator. So these are my entry costs that I account for on every single deal. I account for the down payment to the seller. So this $53,327. You're going to notice that's different than what we have is the $89,000 here, because on the Super Creative Finance calculator, you can also choose the management strategy. And depending on which one you choose, it's going to give you the entry. It's going to take whatever the standalone entry is for the property and then add whatever additional entry costs there are relative to the management strategy. So if it's a co-living room where you're going to need to build out more rooms, more than likely, and you're going to need to furnish those rooms, so there's a larger entry cost. If it's a midterm rental, you're going to need furnishings for that property. If it's a short-term rental, you're going to need even more furnishings for that property. It's going to be even nicer furnishings, maybe more remodels. So depending on what management strategy you select, that's the number that goes into the capital raising piece. Yeah, which one you select. But for every single deal, I have 9 different entry costs for the most part. Those are my buckets, but I bucket those into 3 main categories: acquisition costs, renovations and furnishing costs, whatever it costs to get the property ready for your management strategy, and then reserves for the property. So what I lump into your acquisition is if there's a down payment to the seller, that's accounted for here. If there's arrears or liens, you have to pay back a seller, or you have to pay like catch a seller's mortgage up, or you have to pay off liens to acquire the deal. That needs to be accounted for. Even if it's not going to the seller directly, that needs to be accounted for because that needs to get paid. If there's an agent involved and you're paying an agent commission, that needs to be accounted for. You need to renovate the property just to get it like rent ready. That's accounted for here. There's more renovations needed for the other strategies. Well, that's fine. You account for that in the other areas. Closing costs. Well, when you're buying the deal, you need to account for those closing costs. I account for this separate category, which a lot of people include in their admin. I have it separate because these admin/reimbursement costs are, I've got to pay a transaction coordinator. Usually I'm paying them a deposit up front. I have to form the LLC. Usually that's happening before my capital partner puts their money in the deal, and I'm paying for the inspection out of pocket. These are part of the closing costs, but if I'm raising capital for these deals, I need to get paid back for these. It's nicer and easier to just split this amount up front and say, okay, I need to get paid back for these 3 things at closing for my capital partner and have that here. A lot of people just lump that in their closing costs, which is not inaccurate. It's just, for me, it's easier to see it separate because I know I need to get reimbursed for that. I am paying those costs before closing, and I'll get reimbursed that when my capital partner funds the remainder of the closing costs. If there's a wholesaler involved, then there's an assignment fee that you're paying the wholesaler. If you are accounting for an acquisition fee, this is going to you as the buyer, then you need to account for what that amount is. I would say for the majority, you should not be getting an acquisition fee unless you're getting an incredibly phenomenal deal or you are providing additional services that you're not charging your capital partners for. For example, these acquisition fees cover the costs for my asset manager, which then oversees all of our portfolio that they get to benefit from, includes our property management and why we're able to do a lower property management cost for our partners than just paying someone else like a third-party property management company. They get to benefit from my CFO, my COO, the VAs that we have in the business to help handle a lot of our guest communications and administrative. That's what this is going towards. For the majority of people, you have little to no overhead. You should not be charging an acquisition fee unless maybe the deal is so phenomenal. It really depends. It's up to you and it depends on your deal terms. But adding more towards your entry cost is going to diminish the returns on your deal, making it harder for you to raise capital and result in a higher entry cost, which you may not be able to raise the capital. And the last thing, one of the most important, is carrying costs. These are reserves for your property. So then when you buy the property, we're going to have to, it's not going to be rented right away. So you're going to need to, if you're renovating the property, you're going to need to pay the mortgage. During that time, you need to pay utilities, any other costs associated during that period. You're going to have to pay that. You need to account for that here. And then if you're going to have additional reserves that you're raising for, let's say, maintenance and capital expenditure in the future, these carrying costs / reserves should be accounted for here as well. Rule of thumb, we put at least 3 months typically of the expenses, at least the debt payments at minimum. And then in addition to that, I recommend raising some reserves for the property as well, so that if something goes wrong early into the investment, like you're setting aside maintenance and capital expenditures and reserves, but if something goes wrong early, you're not going to have a big amount in there. It's good to at least have $5,000, $10,000, $15,000 for your property ready to go, just in case something comes up that you weren't anticipating, or a renovation costs more or whatever. It's better to have that ready to go than to ask your capital partners after closing within months to put in more money in the deal. All right, so those are the entry costs, right? In reality, it's 3 buckets: acquisitions, right, rehab and furnishings, and reserves. However, there's multiple parts that are included in there. And depending on the management strategy, there's going to be additional costs. So this renovation and furnishing cost is added to the renovations and furnishing costs you saw here, right? It's adding to that for the co-living management strategy. If you're going short-term rentals or midterm rentals, either one, you have furnishing costs, Well, that you need to account for those as well as part of your entry cost. And that's why there's a new total entry depending on the management strategy on the super creative finance calculator. So you'll see that's why they're higher amounts, different amounts. And that's why it's important to have higher cash flow. If you need more entry, you need more cash flow to then get the same or higher cash on cash return.